Hey everyone, welcome back to Corporate Decoder, the place where we unravel the complex world of corporate finance. And today we're diving into something that sounds a bit like a financial wizard spell, a CLO transaction. Get ready because we're taking a peek behind the curtain at FSKKR Capital Corp, or FSKKR Capital Corp as they're known, and their latest report is a fascinating look into how they're raising money and managing their investments. Before we dive in, if you love breaking down these dense financial reports into bite-sized, understandable insights, make sure you hit that subscribe button and ring the bell. We also have a fantastic community over on Discord where we discuss these kinds of things, and you can find the link right in the description below. So what we have here is a Form 8K filing, which is basically a report company's file to announce important events that shareholders should know about. Today's report is all about a big financial move FSKKR Capital Corp made in late 2025. This is FSKKR Capital Corp, a company that operates as a publicly traded closed-end investment fund, essentially acting as a lender to middle market companies. They've been busy, and this report details a significant financing event. FSKKR Capital Corp is traded on the New York Stock Exchange under the ticker symbol FSK. This means a lot of investors are watching their every move. The main event here is something called a CLO transaction. Now, CLO stands for Collateralized Loan Obligation. In super simple terms, it is a way for companies to bundle up a bunch of loans they own and sell them off as securities to investors. Think of it like making your own investment product out of a collection of IOS. FSKKR Capital Corp, through a special subsidiary named KKR FSK CLO 3 LLC, basically created a new entity to handle this. The subsidiary is described as a wholly owned and consolidated special purpose financing subsidiary, meaning it is set up specifically for this financial deal, and its results are counted as part of the main company's financials. The core of this filing is the completion of a $389,500,000 term debt securitization. That's a mouthful, but it means they raised nearly $390 million by selling slices of these bundled loans. FSKKR Capital Corp, through this subsidiary, is essentially taking a pool of loans primarily made up of middle market loans, which are loans to medium-sized businesses, and packaging them. These loans are the collateral that backs the new securities being sold. They sold different types of debt, each with its own risk and return. For instance, they issued Class A -1 senior secured floating rate notes, which are basically first in line to get paid back and their interest rate can change. Then there are also Class A -1 senior secured floating rate loans, which are very similar but can be converted into notes. They also sold Class A -2, Class B, Class C, and Class D notes. The higher the letter, generally the higher the risk, and therefore the higher the interest rate. The interest rates on these notes are tied to something called term SOFR, which is a benchmark interest rate plus a spread. For the Class A -1 notes, this spread was 1.47%. For the Class B notes, it was 1.80%. And for the riskiest tranche, the Class D notes, it was a hefty 3.15%. This tells us how much they're paying investors for taking on varying levels of risk. These debt securities are scheduled to mature way out in January of 2038. That gives investors a long time horizon to get their money back, with interest, of course. When FSKKR Capital Corp transferred its existing loans to this new subsidiary, the value of those loans was greater than the cash the subsidiary received from selling the debt. This difference is treated as a capital contribution from the main company to the subsidiary, essentially showing the underlying value and health of the assets being securitized. It is important to note that this debt was not registered with the Securities and Exchange Commission, or SEC, under the Securities Act of 1933. This means it was likely sold to sophisticated investors who don't require the same level of public disclosure. Interestingly, FSKKR Capital Corp itself will act as the portfolio manager for this CLO. They will manage the pool of loans within the subsidiary. But in a move that shows confidence, or maybe a way to sweeten the deal, they've waived any management fees they might be entitled to for managing these assets. This is a significant concession, meaning they're prioritizing the success of this deal and the investors over their own immediate earnings from managing it. Now let's look at the exhibits attached, which are the actual legal documents governing this deal. We have the indenture, which is the main contract outlining the terms of the debt between the subsidiary and US Bank Trust Company National Association. Then there is a loan and sale agreement between the subsidiary and FSKKR Capital Corp itself. This is where the transfer of the loan portfolio happens. This is the portfolio management agreement detailing how FSKKR Capital Corp will manage the loans for the subsidiary, and as we mentioned, includes their waiver of fees. And finally, there are the credit agreements for the different tranches of debt, like the Class A -1 credit agreement. These lay out the specific terms for those loans and notes. The asterisks next to some of these exhibits indicate that certain schedules have been omitted. This is common practice for regulatory filings, where sensitive or overly detailed information like lists of every single loan might be kept confidential, but the company agrees to provide them to the SEC if requested. Okay, let's wrap this up and look at the bigger picture. This CLO transaction is a pretty standard, though complex, financial maneuver for companies like KKR Capital Corp. It allows them to free up capital by selling off loans they've originated, and in return, they get cash to either invest in more loans or to shore up their own balance sheet. The fact that they've waived their management fees is a strong signal. It suggests they are confident in the underlying quality of the loans they're securitizing and are willing to forgo immediate income to ensure the success of this deal and maintain strong relationships with their investors. This is a play for long-term stability and growth, rather than short-term profit from management fees. Are there risks? Absolutely. The primary risk lies in the performance of the underlying loans. If the businesses that borrowed from KKR Capital Corp start defaulting on their payments, the investors in these CLO notes will be impacted, and ultimately, KKR Capital Corp could face reputational damage and financial repercussions depending on their residual stake and guarantees. However, the structure of the CLO itself is designed to absorb initial losses through the lower tranches, meaning the most senior notes are protected to a degree. By managing the portfolio themselves, they have direct control over trying to mitigate these risks. In conclusion, KKR Capital Corp is using a sophisticated financial tool to manage its assets and funding. This CLO transaction indicates a strategic move to leverage their lending portfolio. The fee waiver shows a commitment to the deal's success. While the specifics of the loan portfolio's performance are always the key factor, the company seems to be navigating the financial markets with calculated steps. Alright, that is our breakdown of KKR Capital Corp's latest filing. What is your take on these CLO transactions and what they signal for the company's future? Drop your thoughts in the comments below if this analysis was valuable. Hitting that like button really helps us out. And of course, subscribe for more deep dives into the world of corporate finance. Don't forget to check out the Discord community link in the description for more discussions. And we'll see you in the next video.